Hey, hello everyone. Welcome back to this YouTube channel 30 CAGR. My name is Raj, and in this video, we are going to discuss about a very important topic, that is implied volatility versus VIX. Okay, so many people get confused. What exactly is volatility index, or we call that as VIX, versus implied volatility, which is IV. Okay. So in this video, we are actually going to look at the difference and in which case what needs to be used and other things. Before we begin, if you haven't subscribed to this channel, please do subscribe and hit on bell icon so that you get to hear about a lot of new strategies, indicators, algo tools, and other stock market concepts. Okay, so let's get to the topic now. For this video, I'm going to use this platform called Sensible, but you can really use whatever is your favorite options platform. So first, let's see for every index, you can see that we have India VIX and we also have ATM IV. Okay. So what exactly is this VIX and what is IV? Even in Google, if you type Nifty VIX, you get a value like 10, 11, 12 or whatever it is, right? So VIX is nothing but volatility index, that is a measure of volatility that's going to happen in the next 30 days, right? It's like an overall number. So just to compare it, we have Nifty, Bank Nifty, Sensex and all these indices, right? So the reason why we have index is, if someone asks us how is market today, we can't really say that Reliance is up 1%, ITC is down 0.5%, or HUL is up 0.58%. We cannot say like that, right? So we need to have a common value which consolidates or which generalizes the market movement on that particular day or a particular period of time, and we can convey the message to the other person. And for that reason, we have these indices like Nifty or Bank Nifty or Sensex, right? We can say that today market is up 1%. So just like that, we have an index for volatility as well, and that is called Nifty VIX, right? We call that as volatility index. What this exactly tells us is, it exactly tells us how volatile the markets are going to be, right, in the next 30 days. Whether the markets are going to be very volatile or the market is going to be pretty smooth. This is really helpful for option sellers per se, or even option buyers also can make use of this in some cases. But this is a very, very important index or important metric for option sellers, right? So one point to note here is, if the VIX value is higher, in general, if it is above 18 or 19, we treat that as high VIX. So if the VIX is higher, that means there is a lot of fear in the market. And on the other hand, if the VIX values are lower, like 13, 12, 11 or below 11, that means there is not really much fear in the market. And so the option premiums are also lesser. Okay. Remember guys, if the VIX value is higher, obviously what happens is there is more fear. So option sellers will price the options at a higher level. Let's say the fair price of an option is 50 rupees, but the VIX value is at 18, 19, 20 or even 30. Then the option sellers will increase the price of this option from 50 rupees to 100 rupees or even 150 rupees. Whereas let us say the VIX is at 8 or 9 or 10, then there is no fear in the market, everything is calm and cool. Then this 50 rupees options may be priced at 20 rupees or 25 rupees. That's the reason when VIX is lower, option sellers keep saying that the premiums are very low and it's not worth selling options, right? And one key point that we all have to understand here, please note that whether it is VIX or it is IV. Let me actually get my blank board. All right. So whether it is VIX or it is IV, these are the expected volatility numbers, which means nobody knows what is going to happen in future, right? So it is an estimate of volatility, right? We are just estimating that for the next X number of days, market is probably going to be like this. Okay, it's probably going to have a little bit of volatility or maybe a band, okay, like this. But if you look at the history, okay, or after 30 days, if you look back, it might really be like this instead of like this, right? So just try to understand that nobody knows the future. So everybody is trying to estimate how the volatility will be, and that volatility can really be, I don't know, maybe like this. That's what everybody is estimating. But generally what happens is the historical volatility is always lower than the implied volatility or the estimated volatility, right? Let's say you are running an insurance firm. You are offering an insurance to a person. You do not know what is going to happen to that person. So you calculate a little bit of extra risk and you charge extra money, right? But after 1 year or 2 years, if you look back, maybe nothing would happen to that person, but you need to take that extra risk into consideration so that you will not be in loss, right? That's what happens here as well. The implied volatility or the expected volatility is always like this. Option sellers always calculate a little extra risk and then they price the options. But after 1 month, if you look back, the historical volatility might be something like this. I also have some graphs explaining this. You can just go to Google and then type implied volatility versus historical volatility. So it would be something like this. Okay. So the implied volatility, as I mentioned, it's always on the higher side, and the historical volatility might be on the lower side. And mind you, there are certain cases where the implied volatility might be less and historical volatility might be high. And those are the unexpected events like COVID. Nobody would have expected that a situation like COVID might occur, right? So when we are pricing the options, we might factor in less volatility, but in reality it might be a little more or maybe a lot more depending on the situation, right? So that's really the volatility or the VIX or IV that we call. But now really the question is, what is the difference between VIX and IV, right? As I said, VIX is an overall indicator. Okay, so it's an overall indicator for the entire market, but IV is for every particular symbol and strike, right? You have implied volatility for every instrument like Reliance, ITC, Nifty, Bank Nifty, and within that also you have it for every strike, right? ITMs, OTM, ATM, for every strike you have implied volatility. Whereas for VIX, it's a single number. It is derived out of option pricing of all the index strikes. Okay. So if you're talking about Nifty VIX, okay, or S&P 500 VIX in case of US, then they take the options pricing of all the strikes and then they calculate the expected VIX for the next 30 days. All right. Whereas IV, we have it for every strike. Let me show you. Let me show you in the option chain. You can see that we have IV for every strike, right? So even if I take a stock like Reliance, you can still see IV for each and every strike. Of course, always the most important IV that we check for is ATM. ATM keeps changing, so is the IV, but the most important thing is IV. That's why even if you look at any symbol IV, they generally show ATM IV only. Okay, so that's what. So IV is there for every symbol, every instrument, and every strike. Whereas when we talk about VIX, VIX is generally calculated for the index. Okay, they take the option prices of all the strikes and then VIX is computed for a particular index. All right. So that's all we have in this video, and in the next video I'm going to talk about implied volatility in specific. Okay, there are a lot of things that we need to discuss about this IV. What are the use cases where we use this and how IV is derived and all such sorts of things. So don't miss out that video. But in this video, I just want to let you know what's the difference between VIX and IV, since that's the question that people have been asking me very frequently to make a video on, and I thought this might be useful. And if you really like the video, please like the video, share the video, and if you haven't subscribed to this channel, please do subscribe and hit on bell icon. Okay. Thank you so much for watching the video. Have a nice day.